Rhynhardt, looking at the local market, I mean, the likes of Exaro down over 4%, Amplat's down over 4%, Naspers also sitting there near the top of the bottom of the top 40. I don't even know if there was a bottom or top today, because Capital Shopping Centres, the only stock to escape the sell-off. Your view on the huge sell-off we saw across the board?
Look, as you pointed out, it was quite an aggressive sell-off, and I think quite simply, you know, your like heavy cyclical sectors tend to do relatively badly, and then again, the shares that have performed relatively well year to date also took a bit of a beating, which is why you see the likes of an Exaro and a Naspers right at the bottom of the pile. So commodity prices, as you pointed out earlier, is also taking a bit of a beating. So if the trend continues, you know, markets are kind of certainly not in the happy place that they maybe were in early January and maybe even February. I think you know, we have to bear in mind that markets have actually rebounded relatively strongly from the fourth quarter of last year. But right now, some of the warning signs and some of the cracks in the markets are certainly starting to reappear again. You know, the European banking index is in fact making new lows. I think the political uncertainty in Europe is alive and well. We don't know how it's going to like play out. So markets are not happy.
Do you come back to work tomorrow and sell more shares, or do you sit on your hands and hope to ride out this blip in the market once again?
Well, I think ideally, and again, it's probably quite easy with the benefit of hindsight, but I think probably the time to have taken a lot of profit would have been the first or second week of February, because the lion's share of the market's return year to date did in fact come from the first month and a half. I think probably tomorrow, you know, just don't panic. If you have a sound fundamental story for a company that's not expensive, you can certainly hold on. But we do tend to find it very difficult to actually find value, especially in the South African market currently. I think a lot of our shares are fairly dearly valued, especially South African industrial shares. So not a lot of buy ideas, more sell ideas than buys, I think.
Let's focus in on some of the companies that we're looking at right now. SABMiller almost managing to escape the sell-off, but not quite today, sitting down by what, 0.1% today. I was about to say 2.4%, but that's over the last day. The Miller's Co is coming out with their trading update, quarter one trading update, 16.6% growth there in net income. Really doing well there out in America, and this perhaps encouraging for part of their business which was falling back slightly.
Yes, definitely. You know, I think in the current environment, to grow operating profit by close to 17% is certainly very impressive. How did they manage to do it? You know, firstly, it was apparently an unseasonably warm first quarter, so they certainly had the benefit of that, which won't incur again in the second quarter. But also, you know, some of the premium brands that they are selling seems to be gaining like traction. There's a positive price mix effect that is in fact taking place. So revenue in fact beat analyst expectations by close to 3%. And if you have to bring it closer to SAB, you know, Miller Coors is roughly about 11% of group operating profit, I believe, for South African breweries. So I think it is very positive. You know, it's a very well managed company. It's relatively defensive. I think that they will continue to grow. But SAB has had a very good run. And it's not as cheap as what it used to be, but certainly a very good performance from Miller Coors. Interesting
trading update coming through from Massmart, because even though sales, comparable store sales, rose by 8.9%, price inflation only 1.4%. So that's real growth in volumes going through there. What are your thoughts on those numbers? 51.7 billion rand is what they made in the 44 weeks to April.
Look, I think also not a bad result, but perhaps a little bit behind what most sell-side analysts would have been looking for. As you pointed out, sales for the 44 weeks, because they've got a June year end, was up about 15%. And I think it's really not on the volume growth, so like for like growth minus space growth gives you roughly about 7.5% volume growth, which I think is quite impressive. But I think store expansion or space growth is probably the area that have lacked a little bit, and it perhaps maybe just becoming a little bit more difficult to roll out the same number of stores to actually just to keep growing. And I think there's some cost pressures that's going to start rearing its head in the business. I think operating margins are going to take a little bit of strain, even though revenue is growing by 15% and like-for-like volumes are growing at about 9%. So I would expect full year headline earnings to probably be up less than revenue growth. And it's a fantastically well managed company. They run a very lean cost base, and I think any positive synergies from the Walmart tie-up is probably a couple of years away still. And I kind of look at the price earnings multiple of the company, north of 25 times, growing at best maybe 15%, but I think it's probably going to be lower than 10. The share just looks really, really expensive to me at current levels.
That's what everyone's saying locally. Let's move on to the telecom space. Telecom, of course, and KT Corporation. It looks like the agreement for KT to buy a 20% stake in Telecom is likely to go ahead. KT offering 25.6 Rand for each Telecom share. What are your thoughts on the 9.9% premium that they're putting on the table there?
Look, I suppose they do kind of have to offer shareholders a premium. I think it's just a 30-day VWAP premium really, because the initial offer was closer to 36 Rand. Then they started digging around and doing a bit of due diligence, and it's fairly apparent that the business was not in the healthy state what they thought it was. I think net for Telecom shareholders, it is probably quite a good outcome. I think it's quite good to get a strategic partner to maybe help turn around the business in the long term. But in the short term, I think a fair amount of structural issues remain. Effectively they are raising capital. It's just a normal rights issue of roughly about 3.3 billion Rand to pay down balance sheet debt and basically fund capex. So in the short term, you have to live with dilution of roughly about 15% as a current shareholder. And then looking more medium to longer term, I think the core revenues of that fixed line business is continue or in fact will continue to go backwards. I can't really see a quick turnaround, and then I think any kind of restructuring costs will come with short-term retrenchment costs, which will put even further pressure on kind of short-term profit. So if I have to weigh it up and compare it relative to the peer group, suddenly the earnings multiples do not look that cheap. I think MTN is looking cheaper on that point. And then the dividend yield that a Telecom is paying now relative to the likes of a Vodacom and MTN still is not really that great, with a business facing significant headwinds and risks. Yeah. So I don't think Telecom looks that interesting at this moment, but overall not a bad outcome for shareholders.
Rhynhardt, thank you very much for joining us today. Rhynhardt Roodt from Investec Asset Management.